Welcome back to Business Day. Now, of course, no surprise, the political and economic turmoil have led to the financial market turmoil that we're witnessing over the last few weeks, and that's especially true in emerging markets. They certainly may be giving investors a little bit of concern about investing outside of North America these days, but there might still be some value to be had if you choose to do so. Rob Russell's going to join us now, maybe to find out some of that value. He's the president of the money management firm Russell & Company, and he joins us live from New York with a closer look. Rob, good to see you.
Good to see you, too. Thanks.
Well, we might as well start with a larger overview, Rob, while we have you, because the markets have tailed off quite quickly in the afternoon after the comments that we heard from Mr. Gaddafi with respect to staying on, to his last drop of blood, if we're to believe him and take him at his word. But what it does really is highlight the inherent political risks that are inside many emerging markets, and that's part of the reason why people are so skeptical of them.
Yeah, you're right. Emerging markets come with risks, and this is a perfect example of that. And these comments out of Libya and the unrest is pretty much, have the global markets in a stranglehold. So it's still important to have emerging markets as part of your portfolio, because it gives you diversification away from your domestic currency. And really where the growth is happening is mostly overseas. So I think this is just a perfect example why it pays to be picky instead of just buying a whole basket of emerging markets, but being picky on specific types of emerging markets.
When North Americans tend to invest in emerging markets, Rob, they do so through the ETFs. Do you find that the ETF money sort of comes in and comes out en masse and doesn't really reflect the different risks that you'll see in various emerging markets?
Yeah, you're right. It's hard to tell because each emerging market has their own risk, whether it's a geopolitical risk like this, or unemployment or debt levels or that kind of thing. And I think that's why the best way to play it could be the ETF arena, but specific types of ETFs where you can get down and really get down to the specifics of a country or a sector of a country and play it that way.
Well, it's interesting.
You can also.
No, please carry on, Rob.
Okay. And so, another way to play it, of course, is, fixed income is, for some reason, a very favorite of investors right now. In my opinion, and our opinion, that's actually a dangerous place to be is in bonds here, at least in the U.S., with interest rates at all-time lows. Bond prices have only one way to go at this point in the future, and that's down. So, it's better to be buying bonds where we see inflation or interest rates increasing. And where do we see that? It's not here in the U.S. It's outside the U.S. So again, looking at emerging market bonds in the Pacific region of Asia and even some Latin America bonds.
Hang on a minute, Rob. I'm taught that inflation is the enemy of fixed income securities, and inflation is escalating fastest in emerging markets. Why should I buy their debt?
Yeah, and you're absolutely right. If you're a holder of those bonds, but to a potential buyer makes them more attractive, bond prices move inversely with interest rates. So if interest rates go up, bond prices fall. That's why you don't want to be holding those bonds, but more actually buying them, going in, because the bond prices are now becoming undervalued. So I'm not saying go jump in with both feet, but it's time to start adding some of that emerging market bond exposure to the overall portfolio mix. You get a better yield.
Yeah, that's interesting, Rob, because, you're right. The yield is certainly more, it's superior to most things that you're seeing in North American markets. But I wonder if you would differentiate between local currency emerging market debt and that emerging market debt which is denominated in dollars. Where do you see a bit more safety?
Yeah, I'm a big fan of at least, a portion of the portfolio that should be denominated in currencies outside of your domestic currency. Here would be the U.S. dollar. So if we were buying a Brazilian bond, we would buy a true Brazilian bond. So we have a link to their currency, and that actually should be a good thing here longer term.
Okay, we also, Rob, I just want to test your understanding, because we're hearing different definitions about what sort of defines an emerging market these days. For the longest time, we considered the BRIC countries, and you referenced Brazil. But I wonder if it's fair to consider those emerging markets these days, and whether we now have to recalibrate our definition and what you consider an emerging market.
Yeah, you couldn't be more right. I mean, how can you call China an emerging market at this point when, they're a virtual super powerhouse? I would consider more of what I termed the emerging markets, those emerging markets that aren't on investors' radar. Like Indonesia would be an example. People talk about Brazil, but I like Chile better. The lowest corporate tax rate in Latin America, the largest producer of copper in the world. That's where China's gobbling up their resources. So it makes them more attractive, good GDP, sustainable GDP, so on and so forth. But the whole definition or the framework of what an emerging market is certainly has shifted over the time. And I think the opportunities that can be found are the ones that are emerging, again, still off the investor's radar screen.
Chile, certainly a story familiar with Canadians and a lot of Canadian companies heading down there as well. Rob, so grateful you could join us this afternoon. We'll catch up with you again very soon.
Thank you.
Rob Russell, president
All right,
of the
so
money management firm Russell & Company, joining us live from New York.